Have you ever wondered why a bottle of water in Vegas now costs $26, or why those fabulous deals always seem to exclude the dates you actually want to travel? Behind the glittering facade of the Strip lies a financial death spiral so severe that casino giants are literally begging for customers with desperate sales tactics while simultaneously pricing out their core audience. What if I told you that Vegas casinos are trapped in an $18 billion debt nightmare that's forcing them to choose between bankruptcy and alienating the very tourists who built their empires? Today, we're exposing the brutal economics crushing Sin City, the crushing weight of casino debt. Imagine carrying $11 billion in debt while watching your customer base evaporate faster than water in the Mojave Desert. That's exactly what Caesars Entertainment faces every single morning. The debt crisis gripping Vegas casinos represents one of the most underreported financial time bombs in America's hospitality sector. These aren't your neighborhood card rooms struggling to make rent. We're talking about multinational conglomerates that have leveraged themselves to astronomical heights, with MGM Resorts International shouldering nearly $7 billion in debt obligations that demand constant servicing regardless of market conditions. The mathematics of this debt spiral reveals a horrifying truth about modern Vegas economics. When interest rates climb from near zero to over 5%, these casinos suddenly found themselves paying hundreds of millions more annually just to service existing debt. Money that directly translates to higher room rates, increased resort fees, and yes, those infamous $26 bottles of water at the Aria. The debt-to-revenue ratios have reached critical levels, where even a 5% drop in visitor spending could trigger cascading defaults across the Strip's major players. What makes this situation particularly catastrophic is the timing convergence with declining consumer confidence and reduced discretionary spending power among middle-class Americans, the very demographic that built Vegas into a $75 billion annual revenue machine. The casinos borrowed heavily during the low-interest era of 2010 to 2021, funding massive expansion projects like the $4.3 billion Resorts World and the $1.9 billion Allegiant Stadium, all predicated on perpetual growth models that assumed Americans would always have money to gamble. Now, with household debt reaching $17.5 trillion nationally and credit card delinquencies surging 50% year over year, the fundamental assumption underlying Vegas's entire economic model has shattered. The psychological impact on corporate decision-making has been equally devastating, creating a vicious feedback loop where desperate attempts to maintain profit margins drive away the very customers needed for survival. Casino executives, trapped between Wall Street's quarterly earnings demands and operational reality, have resorted to increasingly predatory pricing tactics that transform every guest interaction into a revenue extraction opportunity. The fabulous 5-day sale deception. A staggering 304.2% increase in hotel rates since 2019 forced Vegas casinos to attempt their most audacious manipulation yet, the so-called fabulous 5-day sale that promised value while delivering calculated deception. This promotional disaster exemplified everything wrong with modern Vegas marketing, a desperate attempt to lure back alienated customers while maintaining the very pricing structures that drove them away initially. The sales structure revealed more about casino psychology than any earnings report could. They claimed 120 times normal web traffic without revealing the baseline, a classic statistical manipulation designed to create artificial urgency while obscuring actual demand metrics. The blackout dates tell the real story of corporate cynicism at its peak. Halloween weekend, New Year's Eve, F1 race week, CES convention dates, MLK weekend. Essentially every period when people actually want to visit Vegas was excluded from this generous offer. What the casinos essentially did was package their least desirable inventory, the hospitality equivalent of expired meat marked down 50%, and present it as premium value to desperate consumers seeking affordable entertainment options. The psychological manipulation extends deeper when you realize they're conditioning customers to accept that prime experiences are permanently out of reach for average Americans. Breaking down the economics reveals the sale's true purpose. Not customer acquisition, but investor relations theater. With MGM stock plummeting 18% and facing potential 50% further decline, executives needed something, anything, to demonstrate growth potential to increasingly skeptical shareholders. The sale generated headlines and social media buzz, prices, creating the illusion of demand resurgence while actual revenue per available room, RevPAR, continued its downward trajectory. Industry insiders report that despite the promotional push, actual booking conversions remained below 3%, suggesting that even desperate pricing couldn't overcome the fundamental value perception crisis. The operational impact has been equally damaging to employee morale and service quality. Frontline workers, already stretched thin by post-pandemic staffing cuts, found themselves dealing with frustrated guests who booked sale rates only to discover the true cost through hidden fees, mandatory gratuities, and eliminated amenities. The removal of coffee makers from rooms, a $3 cost-saving measure that forces guests to purchase $8 lobby coffee, epitomizes the penny-wise, pound-foolish mentality destroying Vegas's hospitality reputation. The retail apocalypse inside paradise. Walk through the Crystal Shops at City Center and you'll witness an $8.5 billion monument to miscalculated luxury featuring more for lease signs than actual tenants. A stark reminder that Vegas's problems extend far beyond hotel pricing. The retail component of Vegas's economic model, once a reliable secondary revenue stream supporting casino operations, has collapsed into a ghostly reminder of pre-pandemic excess. These aren't temporary vacancies. Some spaces have sat empty for over 2 years, hemorrhaging potential rental income that could offset debt service obligations. The mathematics of retail failure in Vegas create a particularly vicious spiral unique to integrated resort economics. When MGM Resorts International loses $10 million annually from vacant retail spaces at City Center, they don't just lose rental income, they lose foot traffic that drives incremental gambling, dining, and entertainment spending. Conservative estimates suggest every dollar of lost retail revenue translates to $3 to $4 in lost ancillary spending, meaning those empty storefronts represent $30 to $40 million annual revenue holes that directly impact debt service capabilities. The psychological transformation of Vegas's target demographic compounds this crisis exponentially. The city spent 2 decades courting ultra-high net worth individuals, building crystal palaces and $5,000 per night suites, while systematically alienating the middle-class gamblers who once filled 40,000 slot machines nightly. Now, with luxury retail struggling globally and aspirational shopping declining among millennials, Vegas finds itself with billions in retail infrastructure designed for a customer base that either doesn't exist or chooses Dubai and Monaco over the Mojave Desert. What's particularly devastating is the timing correlation with e-commerce dominance and changing consumer preferences. Physical retail in Vegas faces the same existential threats as mainstream malls, but with the added burden of astronomical rents justified only by captive audience assumptions. When Barney's New York declared bankruptcy and abandoned its Vegas flagship, it signaled more than one retailer's failure. It marked the end of Vegas's fantasy that it could sustain Manhattan-level retail prices in a desert tourist economy. The demographic time bomb. The generational wealth transfer expected to revitalize Vegas gambling has reversed into an exodus, with millennials and Gen Z viewing casinos as exploitative relics rather than entertainment destinations. The statistics paint a sobering picture. Visitors under 40 have declined 23% since 2019, while the average Vegas visitor age has increased to 47.3 years, creating a demographic death spiral that no amount of EDM festivals or influencer marketing can reverse. The fundamental disconnect between casino executives, averaging 58 years old, and their target demographic has created product offerings that feel increasingly anachronistic to digital natives raised on instant gratification and transparent pricing. The economic implications extend beyond simple visitor statistics into fundamental business model disruption. Younger consumers, saddled with $1.75 trillion in student debt and facing 89% higher housing costs than their parents, simply lack the disposable income for traditional Vegas experiences. When a weekend trip costs $2,000 minimum between flights, hotels, food, and entertainment, it competes directly with monthly rent payments for many potential visitors. The psychological shift is equally profound. Generations raised on mobile gaming with transparent odds and instant payouts view traditional slot machines with 85% payout rates as obvious scams rather than entertainment. Social media has transformed Vegas' perception from aspirational escape to cautionary tale about corporate greed. TikTok videos showing $26 water bottles and $14 pizza slices go viral as symbols of late-stage capitalism, creating negative brand associations that million-dollar advertising campaigns cannot overcome. The influencer economy that Vegas courted so aggressively has turned into its biggest liability, with authentic user-generated content exposing the reality behind carefully curated marketing facades. When young visitors share their Vegas experiences, they're more likely to warn friends about hidden fees than recommend must-see shows. The labor market implications create additional pressure points that executives seem unwilling to acknowledge. With Vegas hospitality workers averaging $31,000 annually while facing the same inflated housing costs as visitors, service quality has declined precipitously. The employees who create magical experiences can't afford to live within 30 miles of the Strip, leading to turnover rates exceeding 80% annually, and a workforce that views their employers with the same cynicism visitors increasingly feel. The real estate shell game. Behind every glittering casino tower lies a real estate investment trust, REIT, structure that has transformed Vegas from entertainment destination into financial engineering experiment, where property values matter more than customer satisfaction. The sale-leaseback arrangements that dominate modern casino ownership create perverse incentives, where operators must generate ever-increasing revenues just to meet lease obligations, regardless of market conditions or customer impact. When Blackstone acquired the Bellagio's real estate for $4.25 billion, while MGM continues operating it, they created a dynamic where quarterly lease payments take precedence over long-term brand value or customer loyalty. The financial architecture reveals why prices can never meaningfully decrease. Casinos don't actually own their buildings anymore. Vici Properties, the REIT controlling Caesars real estate, collected $2.1 billion in rent last year, money that must be paid regardless of gambling revenues or occupancy rates. These triple net lease structures, where operators pay rent, maintenance, insurance, and taxes, create fixed costs that destroy operational flexibility during downturns. The REITs demand annual rent escalations typically tied to inflation plus 2%, meaning even if Vegas wanted to reduce prices, structural obligations make it mathematically impossible. Property tax assessments based on theoretical rather than actual values compound this crisis exponentially. Clark County values Strip properties at astronomical levels justified by peak 2019 revenues, creating tax bills that assume perpetual prosperity. When the Cosmopolitan's assessment reached $3.2 billion despite selling for $5.65 billion, it revealed how government entities have become addicted to casino tax revenues, creating another stakeholder demanding their pound of flesh from increasingly scarce visitor dollars. The psychological impact on strategic planning cannot be overstated. Executives know they're trapped in structures that prioritize financial engineering over hospitality excellence. The development pipeline tells the story of an industry that hasn't accepted its new reality. Despite clear demand destruction, $8 billion in new projects remain planned or under construction, each predicated on growth projections that require Americans to suddenly discover additional disposable income. The Oakland Athletic Stadium, projected at $1.5 billion, exemplifies this delusion. Building massive fixed-cost infrastructure while the customer base demonstrably shrinks reveals either stunning ignorance or desperate hope that if you build it, they will come still applies in an era of $2,000 median rent and $6 gasoline. Solutions and stark realities. The mathematical reality facing Vegas visitors demands brutal honesty. Without significant income increases, this former middle-class playground has permanently transformed into a luxury destination accessible only to the affluent or financially reckless. The solution isn't finding better deals or waiting for another sale. It's accepting that structural economic forces have fundamentally altered who Vegas serves. When parking costs $25 daily, resort fees add $45 nightly, and basic meals exceed $30 per person, a couple's weekend easily surpasses $2,500, representing nearly 5% of median American household income for 48 hours of entertainment. The systemic changes required to restore Vegas affordability would require simultaneous miracles: massive debt forgiveness, REIT structure dissolution, property tax reductions, and executives accepting lower profit margins, none of which align with capitalist reality. The more likely scenario involves continued price increases targeting ever smaller wealthy demographics, while middle-class Americans discover alternative entertainment options or simply accept that Vegas, like homeownership and retirement, has joined the list of American dreams relegated to previous generations. For individuals determined to maintain Vegas access, the harsh prescription involves aggressive income enhancement through side hustles, skill monetization, or investment strategies that outpace inflation. Whether flipping vintage books, creating digital products, launching micro-businesses, or learning options trading, the message becomes clear. In an economy where passive participation guarantees exclusion, only those who actively build additional revenue streams can afford experiences that previous generations considered routine. The psychological shift from saving for vacation to building businesses to afford vacation represents a fundamental alteration in the American leisure equation that Vegas exemplifies but doesn't uniquely own. Vegas's transformation from middle-class playground to debt-leveraged luxury experiment represents American capitalism's ultimate paradox. Businesses destroying their customer base while pursuing infinite growth. Until structural economics change or visitors dramatically increase earnings, the Strip will remain a monument to unsustainable finance. Share your thoughts below. Has Vegas priced you out forever? Subscribe for more economic reality checks.